Well, if you're retiring with a tax-free savings account, you're going to want to watch this video. Because if you don't handle the account effectively, it could cost you tens of thousands of dollars of additional tax over the life of your retirement, and it could reduce the after-tax value of your estate. Now, we're going to go through the ins and outs of the TFSA and its tactical use by looking at a case study. Now, before we get into that, just by way of review, of course, the tax-free savings account's superpower is the fact that there's really no restrictions. You can put money in and out and in and out, and when the money comes out, there's no tax consequences, super flexible. Unlike your RRIF as an example, which when you pull money out, of course it's taxable, and you can never stuff money back in to take advantage of the tax-deferred compounding. Now, when it comes to the tax-free savings account, there's all kinds of rules around contribution amounts. We're not going to cover that in today's video. We're going to either presume you know those limits, or if you go to the show notes for this video, there's links to other videos we've done about the tax-free savings account. Okay, let's get into our case study just to outline some of the problems and solutions around the use of the tax-free savings account. So we were talking to Sally. She's retiring in her 60th year. She needs $48,000 per year, and we've inflation adjusted that $48,000 per year in this model. By the time she's 70, she needs $61,000 inflation adjusted dollars. Old age security and CPP benefits, we start at 65, only because we wanted to use the same assumptions in each model. Obviously, the decision around government benefits is a customized decision. This may not be the ideal scenario for her. She was very tax focused, and I said to her, well, we'll look at different models. She was inclined to want to put pressure on her tax-free savings accounts and then draw on the RRSP accounts through RRIF payments so she could take advantage of the tax-deferred growth and then begin taking the income. And so you can see in the model here, she put a lot of pressure on her tax-free savings account, so much so that it was fully depleted by her 64th year in the model. And at that point, she started drawing on RRSP withdrawals. So there's a little bit of money coming out of the RRSP each year, $12,000 to $13,000 per year. And then in the fifth year, about $31,000 came out. And then the last bit of TFSA came out in the amount of $24,000. So very moderate taxes. Okay, so she used that as a working start to her planning. And then we did the tax calculation for her. And over her life expectancy, we took it out to age 90. Her tax bill came out to $266,499. Okay, so what's nice about our projection software, it allows us to model how much total tax is paid with different models. So we suggested to her that she may want to look at putting more pressure actually on her RRSP RRIF accounts to generate cash flow and compare that to putting more pressure on her tax-free savings accounts. So we took a look at that. Now in this model for Sally, everything else is the same with the exception that we're fully funding her income needs for the first number of years by withdrawing money from her RRSP RRIF accounts. Nothing's coming out of her TFSA. Now you can see in this schedule that the RRIF account's fully depleted going into her 81st year, and then in age 81 she starts to draw upon her tax-free savings account to fund income. But in the early years, we're taking it from the RRIF account as an example. Let's look at the total tax bill that's paid in this particular model. So the total tax bill is $220,226. That's a difference of $46,273. So again, it's a meaningful difference, and that's just the start. So the real power of these case studies when we sit down with folks is to do the different iterations to see how we can put more money on an after-tax basis in your pocket. Now, what I want to do as well, just to demonstrate the issues that can happen with a scenario where you're putting too much pressure on your TFSAs, particularly when there's unexpected expenses or even contingencies that have to be funded down the road. Now, again, this scenario has her putting pressure on the tax-free savings account in the early years, and I'm going to model another potential problem, obviously, with that. So you've got this additional expense need. Let's say we have another expense of $45,000 that comes up at some point down the road. So in today's dollars, $45,000 could be for a new vehicle, it could be for renovations in her house. But by the time she gets to age 75, when this occurs, the inflation-adjusted amount is $65,173. Now she's in a difficult situation because she went through her tax-free savings accounts. She's just left with her RRIF account at that point. When she pulls the money out to fund that expense in that year, she's subject to clawback and she balloons her taxes a little bit. In fact, so much so, when you take a look at her tax schedule, she's paying $296,288 over her retirement. The previous number was $266,499. So a pretty big difference in the total tax bill over her retirement years. So again, she might fund it through a line of credit or do other things to sort of get through it so the tax bite isn't as big, but it just illustrates the problem with not thinking through the long-term implications of some of the drawdown strategies. Now, the next part of the case study is to look at trying to maximize after-tax estate value. So we'll take a look at that. Now, a couple of comments before we do that. First of all, I just want to underscore how important it is when you take a look at your retirement income plan, begin to get granular, not just in your base case expenses, but for additional expenses, whether it's vehicle upgrades, extra travel, rentals that you think you might have to do on your property, because that's going to give you guidance and direction on which buckets need to be ready to fund which expenses between your non-reg, your TFSAs, your RRSP RRIF accounts, your corporate account if you have that. This kind of scenario planning really gives you great clarity. By the way, if you haven't had your advisor do this kind of planning, if they don't do it, make sure you go to the website. There's in the show notes under this video, there's a link to our website. There's more information about our services in the retirement income planning area, and you can set up a complimentary call to learn more about our services. Okay, now let's take a look at the scenario where we're trying to maximize after-tax value of the estate. Okay, so this is the more aggressive meltdown strategy. So again, we're using $40,000 per year of after-tax expenses. Sally thought that she could probably reduce her expenditure outlay with the idea that she wanted to look at maximizing estate value over time for charities or grandchildren as an example. So when we take a look at this model, we're much more aggressive in the early years, taking money from the RRIF RRSP accounts. Her overall tax rate was still moderate, a marginal rate of 22.7%, an effective rate of just under 15% per year. And so the TFSA right from the get-go was getting new money every year. So we're taking the money out, paying the tax from the RRIF account, RRSP account, and then rolling some of that money, not just for cash flow, but to push money back into her tax-free savings account every single year. Now, in this particular scenario, we're comparing it against the other scenario that I talked about before, where put a lot more pressure on the TFSA, less pressure on the RRSP RRIF accounts. And so let's take a look at these two scenarios to see how they compare over time. So this column is the meltdown strategy. We're getting through the RRSP RRIF accounts earlier, and this scenario has the strategy where we push money out of the TFSA more quickly in the early phase of the model. Now, what you'll see here is that the total estate value, this is before tax, is $1,836,000, compared to the strategy where we put more pressure on the TFSA is $1,932,000. So it's a little bit larger. Larger by $95,445. However, the tax on the estate on the meltdown strategy was about $35,000, whereas the tax on the non-meltdown strategy was $288,000, a difference of $253,000. So we were ahead from a tax standpoint by that much. So if you look at the estate after-tax value, the meltdown strategy gave us an additional $157,000 of additional value. So again, this is just to illustrate the point. Every situation is unique, but you can see by doing the various scenario planning, you can figure out, okay, how do I maximize my cash flow for retirement, which is the first consideration, and then how do I do that in the context maybe of some estate planning? So it's all about the iterations that we do for clients in terms of building these models. So again, look at the TFSA account as a tactical account. Money goes in, money goes out. It can be finessed based on what your income needs and other expenses that might come up through the retirement years. So I hope you enjoyed the video. Again, if you want other videos on this kind of topic, on the screen right now is some additional video content on tax-free savings accounts. Anyway, wishing you all the best in your retirement and overall wealth planning.